still in a possible leverage structure, Brazil has a lot of money to be used to finance its economy. What is going to happen when you have a lower interest rate and you have a continuous growth? You're going to have, in our view, a massive re-rating effect in the companies in Brazil. And it means that you're going to have more money to invest, and because you're not going to be paying so much interest to those that finance your activities. So you're going to have more money to the real economy. That will also bring more security to the investors. I mean, you're going to be able to gain as much returns with less risk. And this is what we see as an opportunity in Brazil. This is the, if you can make an analogy, I think Brazil, in terms of financial markets, is the US of the early 80s. There's a lot of technology to be implemented in Brazil. There's a lot of technology to help companies to finance their business. Today, interest rate at 12% at the government level, and spreads over that. I mean, there are very few space for you to finance your company at levels as we see in the US. So if the CDI, which is the Brazilian federal funds rate, comes from 12 to 7%, you're going to see that companies that today only can, their cash generation, the EBITDA, can only cover 18 times, it's going to be able to go to close to 40 times. So that will be very interesting to see. There's no growth in capital markets without the right regulatory framework. Brazil has passed its bankruptcy law in 2005, and that has given the ability to investors to take more risks in all the introduction of the law, including alienação fiduciária, which is the right for creditors to regain their assets given as collateral, has been very instrumental in developing all the real estate financing that we see in Brazil today, and new financing to corporations in Brazil. We talked about the demand so far. I mean, what we see here is that the Brazilian banks also have a good capitalization. So there will be money, there will be supply of money coming from the local banks. But it's not enough. Just to give you an idea, in terms of infrastructure, Brazil will need at least 1.5 trillion reais in funds to finance its infrastructure within the next 3 to 5 years. The government has already said that it will only bear with 1/3 of that investment. The other 2/3 has to come from the private sector. So a lot of capital markets instruments needs to be put in place. The banks will need to finance more, and in our view, Brazil will have a very interesting time in terms of development and changes within the next years. How has the debt capital markets developed in Brazil lately? It has been growing at 50% annual compounding growth, which is very high for any economy. But if you look, even with that growth rate, we are only have capital markets representing 11% of our GDP, when in the US, which is the most developed country in that area, represents 51%. So again, there's still a lot of room to grow in financing instruments. These are a little bit of the history of what has been implemented in Brazil in the last few years. So we have a very young and growing capital markets. There have been several instruments that have been put in place, but still, I mean, there is very little when you compare to what you can do. In terms of asset-backed security markets, this is the FDICs, the CRIs, and the CDCAs, all the instruments that we are creating to do a little bit of the disintermediation from banks to those that are borrowing money. It has, if you look at the US, you have a chart there. It shows that the US, basically 21% is what it represents of the GDP. Of course, after the 2008 crisis, it came down to 14%. But when you compare to Brazil, that is only 2.5%. I mean, we still have, again, a lot of room to grow. So here comes the virtuous cycle that everything starts, in my view, with lower interest rates. The government has already showed us the way. It is reducing interest rate. We'll continue to do so. That will have given companies the ability to borrow more and pay less. So the fact that you have capacity in the local banks, and we believe that new instruments in capital markets will also bring additional liquidity to the market, you're going to have the re-rating effect. By having a re-rating effect, first of all, we have opportunity to make money, and second, you're going to have an improved credit protection through regulatory framework, and also because you're going to have more solid balance sheets. And again, you're going to have the development of capital markets and asset-backed securities markets, as you have seen in other economies. And all of that together will bring to growth of the GDP. So Brazil is certainly the place for investors like yourself that are looking for places to place your money for the next 10 years. I mean, Brazil is growing in terms of the duration of its investments. We have been very short-term look in the last 20, 30 years, and that's because, as the governor was saying, I mean, it's not because we'd like to be short-term look, it's just because we need to survive. So Brazilians are looking every day on how to continue to defy the nature of the economy and be able to be ready for the next move. But now we're going to have more room to think more long-term and bring more innovative structures to our business. These are some of the opportunities that we are at Pine are studying and talking to international investors and local investors to together put some of those initiatives in place. High yield funds. I mean, what is the points here? Over-collateralization loans in Brazil are higher than you can see in the US. You have a very limited correlation between guarantee valuation and the default event. What I mean is that Brazilians companies give assets as collateral that are not necessarily related to their business. So if you have a default in the business, you still have some of the other assets to recover your investment. Durations are, again, very short-term, and all the investments are still floating investments, so CDI plus spread. You have the FDICs, which is the similar to CLOs in the US, but it's much simpler structures. In general, you have senior and subordinated shares, would give you subordination of 15 to 30%. So those that are structuring the deals have their equity stake, and that gives them the fact that they're in the same, they align in terms of risks. We have credit rating agencies rating all the funds. Again, it's CDI plus spreads, very attractive returns. Debt capital markets still very small. There's a lot of bridge financing to I'm just finishing. It's very last slide. So it's bridge financing to IPO and capital markets in general. There's a lot of arbitrage here to be gained. M&A, we're going to see more mergers and acquisition and levered acquisitions since interest rates will come down. And restructurings. I mean, there's no development without some of the companies not doing so well. So we're going to be there to help. And that's it. I think I'd like to thank you. Sorry for taking a little bit more of time, and I'm available for any questions that you may have.